Hello everybody, this is my first stock portfolio review for the end of January 2021. I started my investment portfolio in December, quite late to the party I suppose. Went in pretty hard, as you can see there, nearly £40,000. That really represents all of my wife and my spare money, so a pretty big commitment. And I'm going to walk through how I found the first month or two, lessons I learned, mistakes I made, good decisions I had, and everything else. So come with me as we walk through this, my first stock portfolio. Okay, so here we are. Now, I'm a UK-based investor, which means we have something called an ISA, an individual savings account. It's a very efficient tax wrap. So this is why I've divided it like this. Both my wife, Eva, and myself, Liam, we have up to 20,000 a year. So the target here is to make sure that we've invested 20,000 by the end of March, so our financial year basically. And then we have a not immaterial amount outside of the ISA as well. And it's important that I keep those separate for tax reasons and reporting and everything else. This portfolio as well is also gives me a chance to be diversified. So my wife's account has more US focused, it's got more dividend focused. So over time I expect that her trading profit, or the trading profit on her account will maybe be less than my trading profit, but you'll see more dividends on her account basically. So that's a deliberate plan. Partly it's just I think it's good to be diversified, and I've also tried to do it in a way that I think she would invest if she wanted to. So that's what the split is. We've also got the sold there as well. Again, that's important for tax reporting and everything else, and so I can monitor it. And then just a watch list as well, which is always going to be zero, but I do have dozens actually of companies on the watch list, so hence the breakdown there. All of these accounts are on Trading 212, which is I guess it's similar to Robinhood for anyone who's not familiar with it. Okay, I guess first of all, it was fairly disappointing end to January. I had been up over £1,500, and then the last week of January was really brutal. It was actually quite difficult mentally to see 80% of those profits just get wiped out basically in the final week. As being new to investment, I haven't had the fun of a big stock market crash yet, so that I can only imagine what that's like. But still, I am up 330 odd pounds. That's a combination of trading profit and realized profits basically across all three accounts. So I guess I'm pleased that that's moving in the right direction. Yeah, there's a little bit of I might try and tidy this up in terms of reconciliation there. It's you might be able to just like check the numbers and see that they don't quite match. That's partly because we've got some cash, some dividends, and then a free share as well, so it's just like slightly off, which you know, I'm an analyst by trade, so it's driving me bonkers a little bit, but it is what it is. Also as well, there were several times during the month where I just felt like I didn't have enough cash, like there are opportunities that I didn't seize on and really wanted to. You had like the Brexit negotiation and the wobble just before Christmas. Then there was the big crash at the end of the modest crash at the end of January. So there were just a few times where I regretted not having more cash. That said, it was really great to start receiving dividends. I do have a dividend breakdown in a couple of slides. We're not exactly a huge amount yet. My expectation from this is to have about £1,500 dividend from this starting 38,000, so about 4 and a bit % yield. And really my plan overall is to sort of have a 9% long-term return, 5% capital growth, and 4% dividend yield, which is really how I've structured my investments. So. Okay, and now for a bit more details on the breakdown here. So you'll see I split this into US and UK. A bit more on Forex later, but definitely the weak dollar is having an impact on this as well. But you'll see here it looks a bit wonky just because I only started introducing a day-end close from the 25th of January, and I realized it would be super useful. I do also have the data from the 12th. That's really just me exchanging notes with a friend on the 12th, so I had I guess a static copy from then, and then I've taken that date and basically gone backwards to the 1st of December. So it does look a little bit artificial at the moment. The figures are what they are. You'll see here as well the 332 matches with what you saw on the first slide, so everything in the report should be internally consistent if I've set this up correctly. Just as a slight segue as well, this is all using Google Docs, so it's real time. I find it quite useful. It allows me to also do a currency translation in real time as well. So it's just quite powerful to be able to do that. As I touched on, I'm an analyst, so it's not too difficult to set that up. There are definitely some things I'm missing still. Maybe in the future I'll join a website that allows me to track this easier. But for now, I think it's fine to manage. If we have a look at the graph here again, it does look a little bit artificial prior to the 25th of January there, and you can also see what happened in the final week, that sort of depressing dip back down to where we were several weeks ago, so that was again quite sobering, I suppose. Yeah, I think exactly what I just touched on there. It was interesting as well with the US and UK split, so the UK profits were definitely a lot quicker to get started. Part of that is because I did pick up what I think was some really great deals during the Brexit negotiation. I think the deal worth mentioning is Tesco. Tesco, for anyone who doesn't know, is basically Walmart, but in the UK. A hugely powerful supermarket, employs close to 500,000 people, a bit of a beast. And I don't even really know why it wobbled on Brexit negotiations. It's a proper defensive stock, really. But I picked up some, I think, super cheap, and I'm really pleased about that as well. They're sort of my supermarket horse to back, so really pleased with that. Whereas the US profits, I felt like a lot of the stocks, in the US were fully priced when I bought them. Thinking like Johnson and Johnson or REITs or JP Morgan, maybe even. They're great companies, but everyone knows they're great companies, so they were fully priced. So I had to pay full for them, but that's okay. That'll work out in the long run. And the other thing as well with the US stocks is that we're down sort of £440 just on currency movement, so that's also eaten into that as well. So worth factoring in as we go. So this slide is really just a look in detail between UK and US. My long-term plan is to have 50-50 split. I think it's just geographically diversified. It is just two markets, but it's two that I sort of even know very well myself. Or there's a lot of material out there on YouTube and Discord and all those other good things, Reddit included. You can see here again the 332 profit there, but there's quite an interesting split. And on my US ones, really, I only ended up 0.09%. But in fairness, if I factor in currency as well, that ends up at 1.97. So if I strip out the effects and compare on a like-for-like basis, my return on investment actually would have been 1.97 across US stocks and 2.06 across UK stocks. So I'm actually really pleased with both of those, especially the UK one. Like, I really outperformed the index over the same period. That's the FTSE All Share Index there. The opening and closing comparison. And likewise as well, if I adjust for the weakness of the dollar during that period and the impact that had, then I also outperformed the US markets as well. So yeah, I'm actually really pleased with that. Like, when I was reviewing this, the final week taking it from 1500 to 300 was pretty brutal. But then when I compared it to the wider market, it actually made me feel quite good that I'd still outperform there as well. So that's great. I've actually stopped buying US stocks for the moment for a couple of reasons. First of all, because I've gone too heavy into US stocks. I got really excited about REITs in particular. I just think they're really great. About 20% of my portfolio is in REITs at the moment. Like them, and that's fine. But it just means I have to give a bit more love to UK stocks at the moment. But also my expectation is that the dollar's going to keep getting weaker for the foreseeable future, probably going to sort of 3 to 5 year lows. Is my expectation. What I'm reading, I'm not really a forex expert, but I can Google, and that seems to be the consensus basically. So a combination of those two reasons are really why I'm focusing on the UK at the moment. Yeah, and I think although we all had quite good fun with GameStop and Reddit, and it was actually great to see, I have to say, I'm sort of very much on the side of retail investors. It did sort of spook the markets in the final week of January, and to be honest, it was probably a great buying opportunity, and I really wish I had a bit more money spare so that I could have picked up some of them bargains, sort of what I touched on in the first slide. And yeah, in terms of my outperformance, FTSE outperformed by 167, 168%. I should round it up really, and the S&P by 40%. So I'm really chuffed with both of those. I know it's a super narrow time frame, but for me, my first sort of month/2 months investing to outperform the wider market gives me real confidence actually. So that was really pleasing to see. Okay, so next, I had a look at my portfolio. This was when I'd already built my portfolio basically in the middle of January to have a look at risk profiles. Now, we always have beta, which is sort of a measurement of how closely the stock follows the market, but either Google Docs wasn't finding the beta, or the beta wasn't available in Trading 212, or etc. It just was challenging. And the other thing as well, I didn't really find it an ideal measure. I know there are like pros and cons to it. So I sort of copied a YouTuber actually, PPC Ian. If anyone's not aware of him, definitely recommend. And basically what he said is go through your portfolio, put in sort of a fairly arbitrary 1 to 5 or core, and then defensive and speculative and sort of in between as well. And see how it looks. And his recommendation was having sort of 60 to 80% in core, and then 10 to 20% in sort of more risky and less risky. So you end up with a nice diversification in terms of risk profile. It is a little bit arbitrary for sure, but actually I thought it was a really interesting exercise. And you can see here actually that my core, so risk level 3, 63% of my portfolio is in that, and it's been performing respectively. But actually my more speculative investments have done better. In terms of how I'm prioritizing that, really, speculative is either market cap of under $1 billion, unproven technology, unproven company, sort of unproven commercialization. Maybe if it's a really poorly performing stock as well, or there's a high amount of risk to it. Maybe it's like a good company, but it's just fallen on hard times. Especially for level 4, like level 4 has a lot of it has Carnival Cruising, EasyJet. Like these are proven business models and they work, but right now the investment isn't without risk basically. So they're not quite fully speculative. Level 5, those are sort of your SPACs. But they're they're not core just at this time yet, because I do think that there's underlying issues with them. Level 2 is almost entirely AT&T. You could definitely argue that they could be in level 1, almost like as a bond stock with the big yield. But actually, I'm sort of a bit of a defender and a believer in AT&T. I think the HBO play hasn't been factored in at all, and so I do see some stock price, share price appreciation in the medium to long term. I guess a couple of years. And then level 1 is sort of utilities. They haven't really been performing very well either, so it's a quite an interesting split really, because my higher risk stocks have actually been performing much better. So just an interesting reflection here. And I didn't game this at all. I think as long as you're really honest with how you do it, then really great. In terms of risk level 5, my best performer was SBE, Switchback Energy. I think they're merging with ChargePoint, but I got in at 37 and sold at 45 and did it almost twice, like a time and a half. So that was really great. I'm definitely happy to pick up SBE again, but it went to 45 once and I regretted not selling. And then when it went again, I was like a lot more disciplined. I didn't sort of pull the trigger the first time, even though I said I would. Definitely should be a bit more defensive, or a little bit more stick to my guns when I make a plan. Yeah, risk level 4 I think I've already explained, but worth adding Alibaba there. So I sort of liquidated some stuff and realised some profits to buy Alibaba when Jack Ma went missing. I do think that Alibaba isn't without risk. Obviously, we saw what happened when China decided to pick up Ma, making comments he apparently shouldn't have done. But actually, if you look at the numbers behind Alibaba, like it's a fine company, and if it wasn't for the fact of where it's located and the geopolitical risks, that stock would already be worth significantly more. So for me, I think it's worth picking up. I think my average buy price there is about $230, so really happy with that entry point as well. I will definitely be limiting my exposure to China because I'm quite risk adverse politically, I suppose. But I'm happy to have Alibaba in that group as well. Risk 2 is AT&T almost entirely. And yeah, utilities there in risk level 1 as well, so they could definitely be performing better. I'm not in any rush to sell the utilities or the infrastructure companies. I just think that they're not very sexy at the moment. Maybe I bought them at the top as well, and a lot of them are US, and they've been pulled down by the dollar, so that sort of also contributed there as well, which is unfortunate. Okay, next we're going to have a look at sector. Most of these are taken directly from Trading 212, which I guess get them from the market, but they do have my own interpretation on some of them. So, I've sort of grouped ETFs, I've divided consumer slightly differently, technology slightly differently as well, and oil, gas and mining I've put together as well. Maybe in the future I might tweak this slightly, but it's just my interpretation for segments, but this is the one that we're going with basically. You can see here that I've definitely had quite a big split in terms of performance. I've already touched on the speculative there, up at 53%, but also the ETFs have done pretty well, but again it's being overrepresented by a single ETF. Consumers done quite well, financials have done quite well, REITs as well are doing really well, but again it's there are some companies within those segments that are really pulling them up, and I guess the same is also true of the utilities, which have been dreadful. There's a few companies in there that are really pulling them down. Recreational, again, I'm sort of this is long-term holds for me, but I picked them up during COVID, and I'm hoping that as we exit COVID, the business models will come good, and I'll make actually decent returns on some of those investments. So that's just a wheel to demonstrate, basically. I suppose what I would add is that my technology exposure is relatively modest. I wanted to buy more technology, but because I entered in December, everything's so expensive. I do have a few technology companies. I've got Cisco, I've got a UK company called Sage, I've got a couple of shares in Microsoft as well. But really, the technology I was looking for was kind of undervalued or underloved stocks. So I don't have the sort of Apple or Google or Amazon just because it seems so expensive. Disney as well I looked at, if you want to call that a tech stock. It's quite an interesting company. But I just couldn't find many other opportunities to get into tech, so I'm hoping that when there is a market crash that there'll be some buying opportunities for tech. So I think that's more of a reflection of my entry into the market rather than being against tech, because I mean the companies are fantastic. It's just trying to find an opportunity to buy isn't always easy. So yeah, that's definitely part of the challenge. In terms of the discretionary that's doing poorly, we've got the discretionary is doing well. We've got Alibaba and Wetherspoons at the moment. Wetherspoons is a UK pub chain, but I think it will be one of the benefactors and survivors of any retail carnage, basically. And in terms of the ETF that's doing well, it's the iShares Global Clean Energy. It's doing really well and just basically bringing up all my other ETFs. So that's definitely contributed. Also, in terms of what's not doing well, AT&T, Energy Transfer, Con Ed. I don't even really know those companies that well. I guess maybe outside of AT&T. But you watch Google. To be fair, I think they're fine companies, but I sort of do regret maybe not focusing more on UK utilities, where I understand a little bit better. In terms of recreation, EasyJet and Carnival I've already touched on. I am a big believer in those companies. I think they'll bounce back. So for now, I'm just going to sit on a paper loss effectively. So now the hang my head in shame moment. New to the market, I got really carried away with stocks and suggestions and everything else. My portfolio is diversified, but really just has far too many companies. This is a full list of my companies, more than 70 here. This is in order of the P&L, so AT&T sitting at the bottom there. Carnival just above. In case you're wondering why Carnival appears twice, this is really just a reflection of this sits in two different portfolios at the moment. I will try and get to the stage where I'll just have one company in each portfolio for various reasons, but that's how it's set up at the moment. So you can see here there's a couple of big winners. Tritac Big Box is my biggest winner here. That's basically like PSA. It does warehouses in the UK. Virgin Galactic, that was a bit of a result. I didn't get into this when the whole hype was happening around GameStop and everything else. I actually got into it when I had a flight failure, just because some coding happened, and I just felt like the market really overreacted. So I jumped in and apparently did quite well out of that. Alibaba, already touched on, I think. Tesco, again, really pleased with that as well. And Tesco actually announced a special dividend. They sold their Thai and Malaysian business for about 7.5 billion, putting 2.5 billion to cancel off their pension deficit. And they didn't really know what else to do with the other 5 billion, so they've just decided to give it back to their shareholders. It's fantastic news for me. It means that I'll yield about 25% on Tesco this year, so really fortunate. Macerich here also got caught up in the whole GameStop try and give one to the short sellers. I do expect this to go down, but I'm like a medium to long-term investor in Macerich. I think shopping centres are still here to stay, especially more premium or well-located ones. I think people like shopping in the mall environment, so I'm a big defender. I won't go over too many here just because there's so many. Sage Group is my one of my largest holdings. This is a IT software company that does financial packages, basically. So you're looking at sort of payroll, accountancy software. all that kind of stuff, UK based. I just don't really think the market appreciates it as much as it should. I think it's actually got really great numbers. And I actually want to do sort of a segment on them separately, just because I'm a bit of a believer in Sage and the market doesn't seem to be. But I don't think there's too many other surprises outside of that, especially if you're US here, or maybe the UK. Everyone knows Johnson & Johnson, superb company. JP Morgan, superb company. At least financially. I don't know about whether a bank can ever be a superb company, but if one can, I think JP Morgan is the one. If we look at the bottom here, we've got AT&T, Carnival, Energy Transfer. Shell and BP could definitely be doing better, but I'm sort of optimistic on their recovery, and I don't think oil's going anywhere for the next couple of decades, and I think the European oil majors are slightly better than the US ones in terms of two real things. In terms of their break-even for barrel cost, I think is lower. Well, it is lower. I looked at some numbers, and also in terms of their move toward green technology. Like I think their oil majors are real powerful companies, and I don't think they're going to sit on their hands whilst any green revolution takes place. So hopefully that will be there. There's also some things I regret here, like Pfizer. Like the UK has some really great pharmaceuticals I should have invested in, and the US has some better ones than Pfizer. Honestly, I'm annoyed in a way that I invested in Pfizer when I did. May well sell that in February, not sure. But yeah, and BAE Systems, this is sort of like a Lockheed Martin equivalent, slightly worse on space, but slightly stronger in terms of cyber. To me, I just think it's undervalued, and I've been keen to boost my defense and aerospace divisions as well. So I will definitely be aiming to consolidate this. Like I know I got carried away. And yeah, I think from February I'm going to introduce a 1 in 1 out rule, so I will definitely make a commitment that I will have less than 72 stocks by the end of February. That's the plan anyway. Okay, so in terms of dividends, like I say, receiving dividends was amazing. I've never had free money before. It felt like free money. I mean, I spent quite a lot of time looking at stocks and all the rest of it, but seeing the money come in was fantastic, especially because my first one in PSA US REIT, I've got quite a large holding in it, 4 figures. But yeah, when that came in, it's sort of £9, and I've sort of been saying to my wife, you know, it's like, oh, it's free coffees, or it's a takeaway, or it's a pizza, sort of just trying to make it seem more real than this is. I am reinvesting all my dividends, not necessarily in the same company, but I am reinvesting everything, so nothing's coming out at the moment. I think it's the right way to approach it. And you can see here as well the split between UK and US. It is worth mentioning that a lot of US companies pay quarterly, whereas a lot of UK companies pay biannually, or twice a year, I think that's the right wording. So in the UK, it's way more common to have what's called an interim and a final dividend, where it will be split sort of 60-40 or 75-25 or somewhere in between those two. So it's way more important to look at ex-dividend date and things like that, especially for the final dividend, which can be a quite significant part of your overall return. And it just sort of meant that at the moment a lot of the UK stocks haven't had that chance to come through. So this is part of the reason for that split. And also it means that a lot more of the dividends came into my wife's ISA, basically, just because she has more exposure to US and more of a focus on dividend stocks. So that was interesting to see. And I basically expect that to continue. I don't think it's going to change. What probably will happen is at certain periods of the year, the UK dividends will really shoot up when things come in. So sort of Tritax Big Box or Tesco or Sage, when they pay, it'll have more of a contribution, but they're sort of typically twice a year, which is good and bad. I mean, if you're trying to live on dividends, I can definitely see the benefit of moving more toward quarterly or even monthly dividend stocks, so that definitely matters. I did sell one of my ETFs after the record date, is it? So I didn't hold on to it any longer than I had. It was really just because I wanted to free up some money for Alibaba. It was one of the things that I decided to do. And yeah, I mean, my wife's ISA did really well. And it was actually slightly annoying for me. I sort of realised that where I'd entered in December to sort of cost average and everything else, it meant that for HBAN and Cisco, only half of my stocks qualified as being before the ex-dividend date. So, I mean, originally I was expecting to get a little bit more, but that didn't happen. But, I mean, I like HBAN as sort of a regional. It's quite a big bank by UK standards, but by a regional by American standards. And Cisco, I think Cisco's really underrated. I might add some more in February and sort of to average up till at least $48, maybe $50. To me, that stock price should begin with a 6. It's crazy. So that to me is an example of where I believe Cisco is undervalued, a bit like Sage, and I'm happy to put more money into it in the future. Okay, and now we look at shares sold. In the future, I will have a separate slide for shares bought, but basically, because this is my first portfolio, it's everything from a couple of slides ago when I had far too many shares. Yeah, actually quite a lot of things sold for various reasons. Relatively pleased, well, sold what I'm pleased with basically. So I sold out of Chevron and Exxon. It's really just because I was looking at the oils, comparing the super majors. I just felt BP and Shell were better. Also, as well, I get a withholding tax on US dividends, so really it's already wearing down 15% of any dividends I get from those two companies is going to be impacted. And KB, or BK I suppose, is Bank of New York Mellon. I mean, it's okay. I picked it up on a recommendation and then decided I didn't really want it, so I just sold out of a simplification effectively. I was also reasonably happy with the sell of these here. So Evraz is a UK listed, but basically Russian and Eastern European iron ore play slash steel. I do quite like this company. I just decided to profit take and redeploy some money, but I sort of regret selling a little bit just because I do think it's going to continue going up. So I have kept Evraz in one of my ISAs. I think it's in my personal ISA rather than my wife's. We'll be looking to add, especially if it stays under about 500p per share, which is where it has been during January. I think it's undervalued just because iron ore prices at the moment are really high. China is having its diplomatic spat with Australia, where it gets a lot of its iron ore from, doesn't produce enough itself, and I think Evraz is one of those companies that should benefit, and I mean, Evraz is nowhere near all-time highs, so I think there's at least a 20% upside to Evraz as long as it stays under 500p, but even above that, I do quite like it. Not without risks. I think sort of 3 oligarchs own about 40% of it, but still, I think it's a good company. Unilever has been maybe a little bit disappointing, but I decided to just free up some capital and sold for a little bit. SBE exited, took some money, fine. Red Row, I mean, I put here, this is really just to free up some money, and then I redeployed it in either Macerich increasing, basically cost averaging up, or selling to free up some funds for Alibaba. I would say, because I didn't have any cash to hand to really make good use of Alibaba, I did feel a little bit compelled to sell WH Smith. WH Smith is a UK company that specialises really in retail outlets at train stations, airports, etc. Basic stuff like newspapers and sweets and all that other good stuff, but ridiculous margins, massively outperforms competitors. And really a good company, especially once COVID is behind us. So I will be looking to get back into that, similar to Evraz actually, and just hold it for the long term, because I think there's a lot of upside there. And Ennox, I was really annoyed. I looked at this, I sort of, it was trading sideways. I sold for a small loss, and then I looked at it when I was preparing this deck, and I could have, it's basically 100%ed, doubled since, and I really wanted to sort of ride that either into the ground or to the moon, and because I wanted to free up some money for Alibaba, decided to sell out with a small loss. I only had sort of 4 shares in it, so I only would have made about 150 quid. But that would have been an additional 50% on my profits for this month. So a little bit annoying. Definitely missed some upside for both of them actually. WH Smith is also on the rebound at the moment, so a little bit annoying. I hear this one's quite common. So with you, basically in the UK, you have Royal Dutch Shell listed as RDSA and RDSB, and something to do with sort of one is more for Dutch or European mainland, and one is for UK. They pay slightly differently on dividends and tax, all that other good stuff. So I sold out of them, but actually got a reasonable profit. So whoops. My more embarrassing one was JAM instead of JPM. So meant to buy JP Morgan, instead bought an investment trust or an investment account linked to JP Morgan, but under a completely different ticker. Realized I'd made a mistake and just sold out of it. Slightly embarrassing, but I don't really have an excuse. It's just one of those funny things in hindsight, and it only cost me 10 quid. So it could have been worse, but whoops, is probably a fair summary. SFT Shift Technologies, I bought this on a YouTube recommendation. I think it was from Meet Kevin, but I'm not 100%. And I just I didn't really see why. It's one of those things where I was just picking up shares because some YouTuber said it. No disrespect to Meet Kevin, I was doing it with lots of other YouTubers as well. But I'm not really sure why. I looked at the company and I was like, no, I don't really like this company. Maybe in the future I'll look silly and it will actually go up. But I didn't consider it especially fantastic company, so I just decided to sell it. And again, I think that was also to free up some money for Alibaba. So I crystallized a few losses just to jump into Alibaba, which has gone up pretty well. Like all of these losses have been paid for themselves from the Alibaba improvements. So it is what it is, basically. So yeah, that's my portfolio as it stands at the end of January. Definitely made some mistakes. Buying the wrong shares is definitely up there. Not keeping enough cash spare was also another one. And I mean, in terms of reflect on how I felt during the month, there were definitely times I felt really great. Like I picked up a UK bank called Lloyd's when it was having a Brexit wobble. Tesco still, to me, seems like the deal of the day. Also with Sage as well, I think it's my largest holding. The share price was gradually drifting down as it got closer and closer to its quarterly results. And again, I really wish I had some more money to take advantage of it. It was down to like 5.50 a share. I'm in at 5.77, and then as soon as the results got published, it went back up to 610, and I felt reasonably confident it would. But the results were nothing spectacular. They were in line with expectations, but the market just has so little confidence in the company that there was almost a surprise that they hit results, so that was good. So there were definitely times where I felt really great. SBE was another times where I sold close to the top, but there were also times where I just felt like an absolute donkey, buying the wrong shares or not keeping enough cash to take advantage of opportunities. Definitely a mistake. And just seeing all my profits get wiped out in the final week of the month was January. Was super painful. The only thing that sort of sweetened it a little bit is when I looked at the index performance over the same period. It was even worse. So I guess misery loves company. I think overall I'm relatively happy. I'd probably give myself like a C+ if I was to rate myself. The fact I'm in profit, I think, means I must pass. And I'm also outperforming our bank. Like if this had been kept in the savings account, I think we would have got about 0.2%. So it's just definitely outperformed that, and established, I think, some credibility for myself, or some confidence for myself, and some credibility with my wife as well. So for us, this is quite a serious sum of money. We are looking to add to this quite aggressively over the next year, and really for the next couple of decades, ideally. But to enter this way is a big deal. In terms of why we had this money sitting around, 12 months ago we had a baby, and we basically saved pretty hard before that, just in case anything happened. We have both kept our jobs, so that was fortunate, but this is part of the reason why we had sort of a spare 40,000 sitting around just in the bank account, not doing anything. Our little one is now a year old, started nursery, all the rest of it, and it became apparent that we didn't need this in the bank anymore. Hence why we opened up these ISAs, and looking to max out our 20 grand each before the end of this year. There's some really great tax advantages I might touch on in the future regarding UK ISAs. They're extremely beneficial for tax reasons. This has been a bit more of a ramble than maybe it should have been. I'll try and get a bit more concise in the future, but hopefully you've enjoyed this walk through my first month portfolio. And if you've got any value from it at all, like, subscribe, and anything else if you want to carry on watching my journey. Thanks very much, everyone.